Snap's ambitious hardware dreams just crashed. What went wrong with Spectacles? Back in 2016, as Snapchat was valued at a whopping $25 billion, the company made a bold move by launching its first hardware product, Spectacles. These innovative camera-equipped sunglasses aim to blend social media with wearable technology, promising a new way for users to capture and share their experiences. However, the reality was starkly different from the vision. Snap manufactured around 800,000 Spectacles, but managed to sell only 150,000 units, resulting in an astonishing 81% failure rate, culminating in a gigantic $40 million write-off on unsold inventory. Here's the part nobody's talking about. This setback has far-reaching implications, not just for Snap, but for the overall tech industry. Investors need to take notice of these trends and think critically about their portfolios in light of such significant missteps. Snap's failure with Spectacles serves as a critical indicator of the challenges tech companies face in diversifying into hardware markets. Investors need to ask themselves, if Snap struggles with such a pivotal product launch, what does this mean for other tech giants like Apple or Google as they explore similar ventures? The implications are profound, as a dip in confidence in Snap could lead to a broader skepticism towards tech hardware initiatives, potentially affecting stock prices across the sector. Here's the part nobody's talking about. With consumer behavior being unpredictable, especially in the realm of shiny new gadgets, your investment portfolio could be at grave risk. This is a crucial moment for tech investors, and understanding Snap's struggles might just enlighten your strategic choices moving forward. Despite the setback with Spectacles, Snap's underlying business still exhibits signs of robust revenue growth. In fact, the company reported a 3% increase in advertising revenues, totaling $1.24 billion in the latest quarter. This shows that while hardware initiatives may have floundered, the core software components of Snap remain popular and profitable among users. If Snap can pivot effectively and refocus its energies on enhancing its software and user interface, the potential for recovery and growth could exist. However, the question remains, is the potential upside of software growth enough to compensate for the substantial losses incurred from the Spectacles venture? Here's the part nobody's talking about. Investors must weigh these factors heavily in their assessments moving forward. However, the peril for Snap extends beyond just financial losses. The firm's hardware strategy now faces deep-rooted skepticism among investors and industry analysts alike. Concerns are rising that if Snap cannot successfully manage a hardware product, it may negatively impact the company's credibility and future innovations. This uncertainty could lead to significant stock price volatility, particularly if other tech firms perceive Snap's blunder as a cautionary tale. For instance, if companies like Facebook or Google reconsider their own potential hardware projects. Here's the part nobody's talking about. The ripple effects could lead to a broader hesitation within the tech industry to invest in hardware. Moreover, if a similar trend unfolds, it could create a landscape where consumer tech investment slows down dramatically, affecting countless stakeholders. This scenario emphasizes the critical nature of the moment. Understanding the intricacies of Snap's failure could give investors insight into future market trends. The potential risks associated with Snap's current trajectory are concrete and concerning. If the company's stock falters due to the fallout from spectacles, analysts predict a sharp decline could see shares plummet by as much as 20% within the next quarter. Furthermore, investor sentiment could shift, causing a chain reaction affecting not only Snap, but also other tech companies that might also venture into hardware, risking a wider tech market downturn. Here's the part nobody's talking about. Consider a scenario where Snap's advertising growth stalls due to losing market confidence, which could mean revenues dipping below $1.1 billion in the upcoming quarter, an alarming prospect for a company that relies heavily on advertising income. This chain of events could lead to severe repercussions for investors who have placed their trust in Snap's promising narrative. Looking ahead, there are several critical points for investors to watch in Snap's evolving narrative. Key indicators will include upcoming earnings reports, product announcements, and any shifts in corporate strategy aimed at recovery post-spectacles, with Snap's focus shifting back towards their software innovations and advertising capabilities. Monitoring analyst ratings will provide insights into market sentiment and expectations. By Q2 of next year, if Snap demonstrates a solid recovery strategy, it could win back investor confidence. The next few months are crucial, and savvy investors should keep a close eye on these developments to make informed decisions. In conclusion, Snap's $40 million blunder is a stark reminder of the risks in tech investments. With the current environment tilting towards skepticism, my verdict leans towards a cautious sell recommendation for Snap. While there's potential for recovery through their core advertising business, the looming question remains: can they regain lost confidence in hardware? Investors should remain alert for any strategic shifts that could alter Snap's trajectory, as the implications for your investments could be significant. Subscribe to Profit and Peril for the latest in-depth analysis on Snap and the tech sector. Don't miss our upcoming video exploring the hidden risks in virtual reality investments and trends that could impact your portfolio. Stay informed to make wise investment choices.